The economy is weakening and the job market is struggling. The Federal Reserve is about to step in with interest rate cuts. But what does that mean for you? If you're worried about job security, trying to buy a home, or wondering what you should do with your savings, you're in the right place. In this video, we're going to break down how interest rate cuts affect bonds and why that matters for mortgages and housing. Finally, we will look at what smart investors should be doing with their money right now. Stick with me because by the end, you'll know exactly how you can position yourself in this unpredictable housing and stock market. Let's start with bonds because they're key to understanding what happens next in housing. When the Federal Reserve cuts interest rates, bond prices usually go up. That sounds like great news. Retirees holding bond treasuries see their portfolio values rise. But here's the catch. When those bonds mature, the new ones pay less due to the Federal Reserve's lowered interest rates. Retirees will feel a wealth effect. They are richer on paper, but their future payouts shrink as interest rates fall. And here's something most people miss. Interest rate cuts don't always push long-term interest rates lower. Just look at the UK and Germany. Their central banks cut interest rates, but long-term bond yields went up. Why? Investors expect more inflation, so they demand higher returns. If that happens in the United States, mortgage rates could stay high or even climb no matter what the Federal Reserve does. And that brings us straight to housing. Many people hope a Federal Reserve interest rate cut will mean cheaper mortgages and more affordable homes. But long-term yields don't always move the way you expect. As we've seen in Germany and the United Kingdom, central banks have been cutting rates, yet 10-year yields have risen and mortgage rates stay high. If the same happens here, United States mortgage rates could stay elevated or even climb. That creates a tricky dynamic. Housing prices remain supported because supply is tight, but affordability could actually get worse for buyers. Lower short-term rates don't automatically translate into lower monthly payments. So what does this mean for people saving to buy a home or protect their wealth? The housing market may stay strong, but jumping in now is expensive. Parking your money in a regular savings account won't get you anywhere, especially with the Federal Reserve lowering interest rates, which affects the amounts you receive on your savings account. Instead, it makes sense to invest in assets that protect purchasing power while you wait, like stocks or gold. These assets give you a chance to grow your money and shield yourself from inflation rather than sitting idle and losing ground as housing prices rise. Let's go into further detail about what to do with your money while you wait. Gold is one of the simplest options. It's been steady and over the last few years has outperformed the stock market. The long-term returns are still impressive for simply holding a shiny metal. Gold benefits when interest rates fall because cash becomes less attractive, and it's a strong hedge against inflation and money printing. Stocks can also play a role, but you have to be selective. Look for companies that benefit from long-term trends rather than chasing short-term hype. Artificial intelligence-focused stocks like Nvidia, Microsoft, and Amazon are prime examples. They're at the forefront of automation and artificial intelligence. Investing here means that even if automation impacts your job, these companies should benefit, boosting your portfolio higher. Consumer staple funds are usually safe as well. I personally use and love Vanguard consumer staples, but some of the biggest holdings like Walmart, which is at a 37 times forward price to earnings ratio, and Costco, which is at a 50 times forward price to earnings ratio, are extremely expensive right now. That doesn't mean you should avoid this fund entirely, but be cautious. It is useful for diversification benefits, but valuations in certain holdings are more stretched than even tech stocks. The takeaway? While you wait to buy a home or protect against potential job insecurity, invest in assets that offer growth and preserve purchasing power. Gold, selective tech stocks, and consumer staples can help your money keep pace with inflation and give you flexibility for the future. I've shared some of my personal favorite plays. Now I want to hear yours. Leave your thoughts in the comments. So, what does a Fed rate cut really mean for you? Let's recap. Bonds. Prices may rise, creating a wealth effect, but future payouts will shrink as interest rates fall. Housing. Mortgage rates are tied to long-term yields, which could rise even if the Federal Reserve cuts interest rates. Housing prices stay elevated due to constricted supply, and affordability might worsen. Buying a home is still expensive. Stocks and gold. While you wait to buy a home or build a job security cushion, put your money to work. Gold protects purchasing power. Artificial intelligence focused stocks like Nvidia, Microsoft, and Amazon offer growth opportunities. And consumer staples funds provide defense and balance. Just be careful, as names in these funds like Walmart and Costco are at extreme valuations. The bottom line? Rate cuts are coming because the economy and jobs are weakening, not because everything is booming. Use this time to protect and grow your wealth. I've shared my personal approach, but I want to hear yours. Which assets are you leaning on right now? Gold, artificial intelligence stocks, consumer staples, dividends, or something else entirely? Drop your thoughts in the comments. If you found this useful, make sure to like. Otherwise, thanks so much for watching until the end. You have no idea what that means to me. Bye.